Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders Weekly for the week of August 11th, 2024. In this week's episode, I am going to take a look at a SBUX trade that I still have going on from earnings back in April and let you know how it's going and how I continue to keep pulling premium out of that trade. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find us, let us know and we will get it there. But let's hop to this week's content. In this week, I want to touch on SBUX because they recently reported earnings again, and it was one earnings cycle before this most recent one where I actually entered with a short strangle. They basically blew through the bottom side of my strangle, and I was assigned 200 shares, and I wanted to kind of update you on how that trade's been going and the type of things that I've been doing to continue to milk premium out of that trade and continually keep my cost basis going down and down and down while I kind of wait for the ability to unload those shares at a profit. Now, this trade started back in the first quarter of earnings where I entered just before the earnings on April 30th. And so let's bring up kind of the historical chart of what I've been doing with this trade since I opened that original short strangle. So right here is the kind of history of this particular series of the two calls or two strangles that I put on back in April. So I started off with about a 20 delta earnings strangle. That's where I kind of go 20 delta to the low side, 20 delta to the high side. I sell both a put and a call on extended volatility. And the play here is that the volatility will be overstated and we will stay within that move and the premium will rapidly decay away after the earnings announcement is out and the uncertainty is gone. This is one of those trades that did not pan out in that idealistic textbook fashion. This does happen probably 15 to 20% of the time based on statistics of the deltas that I choose for those strikes and based on the historical data that I've collected since I've been doing this strategy. So it's not that big of a deal when I got assigned going into any earnings announcement and any naked option selling. I'm always have to be okay with assignment, whether or not that is assignment to the short side or assignment to the long side. In this particular case, I got assigned to the long side. So I had originally sold an 83 put and a 95 call, collecting $1.48 per contract. I did two contracts, so I pulled in $296. Now, SBUX dramatically disappointed earnings back then in April, and it went way through the bottom side of my put. Now, normally I would try to roll that put, and I was able to kind of roll just once, but the conditions continued to deteriorate, really making another roll just not possible, and I ended up getting assigned on May 17th. So the way that I do that is when I have earnings, I play for the expiration of the Friday of the week of earnings. So on April 30th, those contracts that I sold expired that Friday. And then what happens is if I have to roll something because a strike has been breached or my profit targets weren't hit, I will roll out to the next available monthly. And so that's what I did there in April. May was the next available monthly. So I rolled out to that monthly expiration of May 17th. Unfortunately, the price action deteriorated, volatility kind of went down, and I was unable to roll for any type of profit. So I got assigned 200 shares at $83 a share. So at the time that I was assigned, I think it was trading around $75 or $76 a share. Ironically, that's exactly where it still is today. Now, once I get assigned those shares, I will try to sell calls at that assignment price or at my break even or higher. So I was able in June, on June 6th, I was able to sell a covered call at the 83 strike. So that was where I was assigned. So that, was a little actually above my cost basis because you have to factor in the premium that you was collected. So I had collected, a little more than $3 or $1.50 a share because I did 2 contracts, 83. So you got to take that off of that 83 for your cost basis. So 83 was above my cost basis, and I went ahead and sold that for the following monthly expiration. Now I'll pull up a chart that will also visualize this in time as well in a minute after I recap this. So those ended up expiring worthless. I sold 2 of those, $1.27 a piece. So that $254 again, I kept lowering that cost basis. So on June 21st, after that first set of June expirations, I went out to the July expiration and I sold more. Now at this point, there was kind of upward momentum in SBUX when I sold it. And I thought, oh, you know what? Let's kind of push up, try to get assigned at 85. So I actually sold the 85 calls. Again, that's above my cost basis. I probably, in hindsight, could have collected more if I had lowered it. But like I said, SBUX was kind of on an upward momentum-ish. And so I wanted to push that assignment price higher because if they breached that and I was assigned, I would basically get $85 a share plus all the premium that I've collected. So I did give up a little bit of premium on that. Was only able to sell those for 60 cents a contract. I did sell 2 of those, and those also expired worthless. So again, I kept that $120. Then that brings me to the next earnings announcement of SBUX. And again, volatility had been creeping up and up and up continuously as we went into this uncertainty period. And so I decided to sell a covered call against earnings. Now, the one in June, June 6th and then June 21st, both of those were monthly expirations. Now, going into the earnings here on July 30th, I did not sell a monthly expiration. I went ahead and sold of the week of expiration, week of earnings, the expiration. So this was on July 30th. Earnings, that Friday expiration was August 2nd. So this is like a 2-day option thing. Now, I had looked back on what I had collected, and I decided that SBUX, which was trading around, I don't remember, 74, 73, something like that going into earnings, I said, well, let's go ahead and do an 80 call. Again, this is above my cost basis because if I take in all of the premium that I had collected to this point, I had been lowering my cost basis. Yes, I paid 83 per share, but you have to factor in all of the premium that I had collected, which lowers the cost basis. And so 80 was above the cost basis. It expired on that Friday. Volatility was super extended. And so the play here was to go with the overstated volatility. I was hoping for positive movement upward, but I didn't want to breach through that 80 strike. And so I went ahead and I sold 2 80 calls, was able to collect $1.26, which is really, really, really high premium, considering those options were only good for 3 days. July 30th all the way to August 2nd is when they expired. Sure enough, earnings actually was positive. There was movement. It actually breached through the 80 call strike, but however, it did pull back below that 80 strike prior to expiration. And so I still have those 200 shares, and I was able to keep that additional $252. And that brings my total collection of all of this premium to a little bit over $1,000 or $5 a share. And if you take my assignment of $83 and you subtract that $5 a share off of there, you get roughly $78 cost basis per share of SBUX. Now, one thing to call out here, because I do own these shares, SBUX does pay a dividend. There is an ex-dividend date coming up on August 16th. That is the end of this week that this episode will air. And that is a 57-cent dividend that I will get per share. So that will automatically go into me because I will not likely be assigned because I don't actually have any covered calls out there sold. So I'm just holding on to 200 shares. I will be looking to sell probably the next monthly, so August monthly expiration, potentially September, depending on the premium. Right after an earnings announcement, volatility really kind of comes back down and contracts. So I'll probably wait just a little bit to either have the price action drive up higher or volatility build, or ideally both. And I will sell another covered call to pull down that cost basis. Now, that expiration will most definitely be after this ex-dividend date. So the likelihood of early assignment to get those shares called away from me is relatively low, especially considering that I will probably be looking at an 85 strike to sell. I don't know that I will go as low as an 80 strike just based on where it's trading at $76 now. So we'll see. But this is really where I want to say, look, I'm getting paid to hold these shares. Yes, it is consuming a good chunk of buying power. So because I am now holding the shares, it is taking about almost $15,000 of buying power to hold these shares. However, the premium that I have collected is a result of about 7% return on capital. And so that is well within my wheelhouse, and particularly if I can keep selling and milking the premium here off of this on a monthly basis, it, in my opinion, more than makes up for that kind of loss of buying power because it brings consistent income into my portfolio. And like I said, when I go into these short positions and the earnings, I need to be okay with that assignment. And I am usually very much okay, particularly when a particular stock also pays a dividend. Because if you end up getting assigned to the long side, you're still going to collect that premium of your dividend, and you can continually sell covered calls against it to keep working down that cost basis. And so it's a way to hold shares, and while you're holding them, lower that cost basis continually, just kind of chipping away chunk by chunk, bite by bite. So let's take a look here at what this looks like from a chart perspective. Now, what I've done here is I have pulled up and put forth on this chart the original strangle, which was out here starting on April 30th. This was a pretty short strangle because, like I said, it went to that Friday. You can see we were approaching right in the middle of that strangle, broke way down through here. I was able to roll once, and that was about it. And I wasn't really able to get good premium because volatility really contracted shortly after this earnings announcement. And so because we were so far away from that 83 strike, I had to wait for that price appreciation to kind of build and build and build. And this is where I was able to get back in this next red box that I'm highlighting here. This is the June 6th entry at the 83 call. And then that went to expiration, and you can see that the price stayed below my strike. And then here is where I went ahead and opened up, pushed up to 85. I was kind of seeing this positive price movement here as we were building, and that's why I pushed up to that 85. That's not actually what happened. We ended up giving back and continuing to fall off here. And so that went ahead and expired on that next monthly. And there really wasn't a ton of volatility. I was just kind of waiting for the next earnings announcement to have that volatility build and build and build. That was what happened in here, is volatility kind of built. And then right here on July 30th, you can see I went ahead and sold. So this is where the earnings came out. Like I said, the earnings were very positive, and there was a big jump in price action, and volatility was overextended. I think it was in the 90-some percentile of historical volatility, and that's really, really the sweet spot when it comes to selling premium, because there is a much higher probability that that volatility is going to be overstated. And that is exactly what happened here. Like I said, you can see these wicks where we kind of punched up through that 80 strike, but the market really deteriorated broad scale for, unrelated to Starbucks earnings, kind of gave back and went ahead and expired worthless. Like I said, these were only good until that Friday. They were only a 3-day play. So right now I don't have any other calls being sold. However, I am going to watch this to see if we can build on this price action, kind of pushing back up into the upper 70s, maybe 80. And when we reach there, I'm going to go ahead and look for options to sell more covered calls. And right out here, you can see this is the ex-dividend date I was talking about, coming on August 16th, which means basically if I am a shareholder on August 15th, which there is an incredibly high likelihood of basically still holding this on August 15th, I will be eligible to collect this 57-cent per share dividend, which will get paid out at the end of August. So just a quick note here on dividends and how you read this. Ex-dividend date. This means that this is the first date on which the stock trades without the expectation of collecting a dividend. So when it says ex-dividend date of Friday, 16th of August, that means If you bought on the 16th of August, you are excluded from the dividend. So ex-dividend date actually means the date at which the dividend does not apply to you, the first one. So you need to be a shareholder the day prior to the ex-dividend date. So that's why I said if I am a shareholder as of August 15th, I will be eligible for the dividend, and it will pay out to me on August 30th is the payment schedule here for SBUX. That brings us to the end of this really quick episode this week of just, what happens when you get assigned? What do you do? What does it look like? And hopefully you're able to see that, assignment is not scary. It might sound scary, but fundamentally all it means is you get to be a shareholder, and going into selling naked options, as long as you are okay with that as a potential outcome, then it's not really scary. And if anything, I try to view it as, I get this opportunity to hold these shares at a discount. And the reason I say at a discount for two reasons, really. One, you get to pick the strike at which you will be assigned. Okay, that's the assignment strike. Plus, you're collecting premium on that strike. So you're basically getting paid to fill an order at the price you want to fill. And then once you hold those shares, you're eligible for dividends. You're a full-fledged shareholder. You can sell covered calls against it to collect more premium and then continually lower that cost basis. So as long as you continue to sell at strikes that are at or above your cost basis, you really can't lose money. Where you get into the potential to lose money is when the share price deteriorates so much so that in order to sell a covered call, you have to sell at a strike below your cost basis. That's okay to do, but you got to be careful with that, because if you happen to get assigned below your cost basis, you're going to be losing money on the overall trade. Now, maybe that's okay because you want to get out, you want to collect the premium, you want your buying power back, whatever reason that might be there. In my strategy, I want to always be moving in the positive direction on overall collection of funds. And so that's why when I go to roll, I will only roll if I can do it for a credit. Some stocks like the SBUX stock where I told you I couldn't roll, I couldn't roll for a credit. I could have done it for a debit, but to me, that is taking on additional risk. Why would I lower the premium that I've been collecting just to simply push out in time more? If I'm going to roll, I want to collect a premium. If I'm going to be assigned, I'm going to chip away, and I'm going to only chip away selling covered calls at or above my cost basis. So I am constantly trickling in a positive profit into my portfolio. So hopefully that gives you a little bit of insight, and you are finding things to trade out there. The market has gotten incredibly volatile in the past couple of trading days. The VIX has really spiked, so I'm getting pretty excited about that, because this usually means that a lot of fear comes into the market, a lot of volatility rises, and volatility is one of the largest contributing factors to the amount of premium of options that I like to sell. So I definitely will be looking out for some excellent opportunities to sell premium, overstated premium, to basically sell the insurance to the people that are very worried about rapid declines in the market. So hopefully you're finding something that you like to trade and you are being profitable out there. Remember, think outside the block.